I see some familiar faces, so thank you for joining us. And for those that may not know us as well, my name is Martin Luplo. I head up production over here at the Commonwealth Group. And along with myself, I'm introducing the folks that are going to be speaking on this webinar. We've got Grandy Ray and Cody Person here as well, who head up our quality control department. So excited to hear what they have to say today. They went up to the Fannie Mae Risk Management and Compliance Conference up in Washington, D.C. a couple weeks ago. They took expert notes, and so they're going to update us on what they learned up there, what Fannie Mae's cracking down on nowadays. I know everybody is interested in hearing that. They're also going to briefly go over some of the recent Fannie Mae QC guideline updates that came through this year. So they've prepared a really interesting webinar for us, and we'll be monitoring the questions. If you guys have questions, feel free to drop them in the chat box, and we'll try to answer them at the end of the webinar. And if we're not able to get to them for whatever reason, we'll hold on to them and we'll email you individually to make sure that we answer all the questions. But before we get started, a little bit about the Commonwealth Group. We are consultants to mortgage lenders. We help people get their Fannie and Freddie approval, their HUD approval. We do various types of audits. We we help with HMDA reporting, with MCR reporting, pretty much anything and everything under the sun, consulting related, we can help you out with. So that's kind of the foundation of our company. And on the other side of the fence, we have fulfillment services too. I'd say we're most known for our contract underwriting, but obviously we've got a wonderful quality control department. We've got contract processors. We do Encompass administration, and last but not least, but we do condo project reviews as well. So we'd love to help you out if we're not already helping you out. But stay tuned here. The QC crew has got a wonderful presentation for you. So with that, I'll turn it over to Grandy and Cody here. Take it away, guys.
Appreciate it, Martin, and thank you everyone for joining us. So Grandy and I, we went up to Washington, D.C., and we, of course, spent some time walking around the city and got to see a lot of monuments and museums, and we just had a great time and can't recommend it enough. If you haven't had the opportunity to go up there, it's definitely a great city to visit. But aside from all the sightseeing, we were able to attend the MBAs Compliance and Risk Management Conference, and we're excited to share our key takeaways from the session with you all. But before we get into what we learned at the conference, we would like to show you about the new Fannie Mae updates.
All right. Good afternoon, everybody. So I'm sure you guys are aware of the recent Fannie Mae QC updates. They went into effect on, I believe, September 2nd. In my opinion, there's not a lot of drastic changes to any of them, but we still wanted to take our time and hit the high points on these and make sure you're aware. So, okay, starting from the top, pre-funding. Previously, Fannie Mae required that 10% of the previous total month's production be submitted for pre-funding QC. They've now changed that to where it can be 10% of the previous month's total production or 10% of the current month's projected origination. So you're getting a little bit more flexibility there. I will say, though, if you're going to go off of the 10% of the current month, just make sure you're taking a double check towards the end of the month and making sure that you met 10% and you're not under that threshold. Okay, so occupancy. So for the longest time, Fannie really only wanted an occupancy assessment on the post-close side for primary transactions. They've now updated this to all type of file reviews. So pre-funding, post-close, and residency type. So secondary homes, primary homes, investment properties. And I know Cody and I, both coming back from an underwriting perspective, we've always made sure to take a look at this regardless if it was a pre-fund, post-close review. And we've gone into our report and added a little check mark that includes that for any investors or Fannie if they directly ask about it. So with that being said, if you're not sure if you're current QC persons actively doing that, I would definitely ask. Okay, TPO. So Fannie Mae is now wanting 10% of TPO loans reviewed monthly, including a discretionary review. That could be a component review for pre-funding, or it could be a post-close review. Previously, I believe it was every 12 months from every different TPO originator you were going through. So if you're involved in that business, make sure you're including your TPO loans in monthly total production.
Okay, well, back to what we learned in the conference. Oh, you want to go back here?
No, you're fine, Cody. So I was going to say there's one more I was going to hit on, but as I kind of said, a lot of these changes aren't too drastic, and they're kind of been they had been in writing for Fannie Mae for a best practice implementation. So we didn't feel the need to go through every single one of them and bore you with that. But that being said, if you have any questions on these recent updates, don't hesitate to reach out to me or Cuddy directly after this via email, phone call. My phone line's always open.
So the main points that were stressed in the conference were significant defect findings. So we've got this chart here from Fannie Mae that outlines their top defects from Q1 of 2025 through Q2. The top one here is misrepresentation of primary occupancy. So obviously that has a pretty high prevalence right now. A lot of people are talking about it. The next one down is incorrect income calculations with specifically with rental income or loss. And then we also have incorrect income calculations with base income. Then below that, we have ineligible properties. So this is another stress point that the GSEs were talking about with safety, soundness, and structural integrity. Then we have income misrepresentation, insufficient assets to close below that, monthly payments not properly calculated, income not documented, and that's again with rental income, omission of debts documentation missing or insufficient, and then also just the borrowers just flat out not being employed.
Okay, so for Friday, you'll see a little bit of similarity between both of these, between Fannie and Freddie, excuse me. So for example, income calculation was a top defect for Q1 and Q2. And a lot of this was due to variable income. So borrowers with fluctuating hours, bonus pay, OT pay, commission pay, so on and so forth. And then right above that, you'll see collateral. And there, that is referring to soundness and safety. So the appraiser's marking the report as is. Freddie's picking it up for review. They're finding holes in the siding, damage to the roof, evidence of flooding, wet spots on the wall, whatever you can think of. And then I'll also note there, if you look back, that first chart is from Q3 of 2023. You'll see that that's slowly starting to rise a little bit. So it was 14% in 2023, and then Q2 2025, it's 21. So Freddie was putting a strong emphasis on soundness and safety. And then after that, you have liabilities, which was due to current liabilities being admitted and not having documentation to support it, or on the post-code side, a soft pull being pulled and borrowers took out a car loan one day prior to closing. And then in that next chart, you have eligibility, and that is referring to the comps not supporting the valuation. So Freddie's taking a look at it saying this doesn't support the value of XYZ. They're doing their own analysis, and that new analysis pushes LTV outside of guidance. And then above that is assets, which is pretty straightforward. Missing documentation for large deposits, get funds. In some instances, it was just the donor source was inadequate. Was it coming from a family member? Was outside of guidance? And then lastly, other, which was a mixed bag of didn't meet Freddie's typical credit requirements, wasn't a valid first lien, credit report was insufficient, and miscellaneous missing documentation. So with that being said, we're not going to hit on all these defects that we just mentioned from Freddie and Freddie. There were 3 that really stood out to us, and that Freddie and Fannie both took the time to harp on, with the first being misrep of occupancy. And I'm sure that's not a big surprise. There you go.
Sorry,
No, you're
kind of
good.
glitched out on me there. That was a little
No,
strange.
No
Yeah,
worries
so-
at all.
With occupancy misrep, the biggest factor, like indications of detecting it, are discrepancies in documentation. And we have a few listed out here with EOI, the sales contract, the mailing address for refis, things of that nature. But a big thing that we like to do here in the Commonwealth Group is we like to ask ourselves, does this transaction actually make sense? And, for example, if we have a borrower that has 4 or 5 kids living in a 4-bedroom home right now, and they're downsizing into a 2-bed, 1-bath condo, that kind of doesn't make a whole lot of sense. So just using those, types of situations that maybe they raise an eyebrow or a red flag, and just using your judgment and kind of determining if that makes sense.
Yeah, no, yeah, you're absolutely hitting the nail on the head there, Cody. So, and back to the discrepancies in documentation, we've seen it. We always love to take a good look at homeowners insurance for pre-funds and post-close reviews. We've run into instances where it's a primary purchase or primary refi. We get the homeowners insurance and it's reflected for a rental property. Or, on the sales contract, there's a little nugget on there that's saying the intended use of this property is going to be a secondary home or an investment property. And then on refis for primary transactions, take a good look at the mailing address on the borrower's bank statements, pay stubs. If there's a totally different address there, I mean, you're going to want to go back and ask the borrower about that discrepancy. So, I lost my train of thought there for a second.
Thing is, making sure on the post-close side of things, you can use the third-party data checks, like checking Zillow to make sure the house isn't for rent or something like that. It's always a good thing that you can do in that process as well.
Right. Yeah, that's a great point. On post-close side, it's unfortunately a lot more messier catching potential occupancy misrep. But on the post-close side, we also use third-party sites like Cody was just saying. Go on Zillow. Is that property showing up for rent in XYZ city? Okay, so soundness and safety. This was both the top defect for both Fannie and Freddie, and this really stuck out to both of us. Fannie and Freddie said a lot of these files they're catching that have soundness and safety issues are files that have rep and warrant. So that being said, I can't stress the importance enough of going through and make sure your team is carefully reviewing photos of the subject property. Just because you're getting a 1 on the SSR score, the UCVP, that's that score is not correlating to the condition of the subject property. And then additionally adding to that, it's the old age mortgage saying that just because the appraiser marks the report as is doesn't mean it's as is. I mean, Cody, I know you've seen it countless times. I've seen it countless times. We'll pick up a pre-fund or a post-close review. Appraisers marked it as is, and there will be a big tree limb hanging on the roof. There'll be holes in the drywall. There'll be evidence of flooding or previous flooding, whatever you can think of. So, you really just got to make sure you're being diligent on not only reviewing the sales comparison, but the actual photos of the subject property. And then also, the appraiser's not, state improved inspector or an engineer. So if you think there is an issue, don't be afraid to override them and, go out and get an additional inspection or additional repair. It might seem like a headache in that moment, but it's a lot better to be, careful than this file being picked up later and there being an issue with it.
Absolutely. All right. So we saw a lot of issues, or a lot of talk about income issues, and big one being inherently complex income calculations like self-employment. Maybe a borrower has 3 or 4 businesses that he's receiving income from, or maybe the borrowers have multiple investment properties. They've got 10 or 15 rental homes. Then you've got to go through and calculate the income on that. So something that we like to stress is utilizing the income worksheets. We really like Fannie Mae's Form 91 and obviously the 1084 for rental income calculations. Granny, do you have anything that you wanted to add on that?
Yeah, no, absolutely. I think, you're definitely in the right direction there. Sometimes you'll pick up a file where it's, it has 5 investment properties on it. So, just really stressing the importance of using rental income worksheets or self-employed income worksheets, and not only utilizing them, but, double checking that the data you're entering is correct. So a lot of times, not a lot of times, excuse me, but, we're all humans. We all make mistakes. So there's a chance that, you get a fat buttoned a number, and it could be thrown off the income calculation there. And then also on like Fannie Mae's Form 1084 that you mentioned, Cody. So they're offering rep and warrant for self-employed borrowers and rental income calculations if you use their worksheet, and all they ask is you enter in the data correctly, and you're not manually overriding that income calculation when you enter it into DU.
Yep. And another point was their finding defects with variable income. So that could be like OT pay, bonus pay, commission pay, fluctuating hours, like maybe like a seasonal job or something like that. So few points that we wanted to make is that if income is increasing, you want to take a 2-year average. You definitely, that's best practice, right, Grandy?
Absolutely, yeah. So, if it's increasing and stable, take a 2-year average. If it's declining, you got to back out the higher amount, take year to date. And then, if it's been declining for 2 years straight, we love to see a letter of explanations from the employer stating the reason behind the decline, and then it has stabilized and it's not going to decline more.
Yeah.
So, kind of wrap this up, we've talked about a lot of variables that kind of create a riskier file. And there's many different ways we can help, especially on the pre-funding side with component reviews, which is a partial review of the file targeted at one area instead of a full file. So maybe you have a file where you got a borrower that owns 4 or 5 different businesses, and DTI is in the 40s. You can submit that to us for pre-fund, and we're more than happy to take a look at that. And bonus points to that is, it counts towards the monthly pre-fund requirement. So you're really killing one bird with 2 stones there. You're getting a second opinion and mitigating a bit of risk, and you're also checking part of the pre-funding monthly requirement off your checklist. And it's not only income based, it's also assets and collateral and credit. So definitely highly recommend and take advantage of that.
Absolutely. that pretty much wraps it up. I don't know if anyone has any questions that have been dropped into the chat, but if not, and if you think of anything down the line, you're more than welcome to reach out to us, and we'll send this presentation out to everyone in the meeting. But we got our email addresses there, so feel free to reach out if you have any questions. We're more than happy to help you. And yeah, that's all I've got. Grant, do you have anything else to add?
That is it. I appreciate everybody taking time out of their day to join. I hope everybody has a great rest of their afternoon.
Thanks, guys. Yeah, I've been watching the chat here, and I don't see any questions coming through. But like Randy and Cody mentioned, great job, guys, by the way. But very informative. But like Randy and Cody mentioned, we'll be following up with the slideshow. We'll post the recording of this to YouTube. If you had to hop off and take a phone call or something like that and missed part of it, we'll make sure everybody has excuse me, the complete copy. And then if any questions come to mind, just respond to the email that we send out. We'd be happy to help you out and answer those questions then. So once again, thanks for spending part of your afternoon with us. Great job, Cody and Randy. Thank you all.
Thanks,
Thank you,
everyone.
everyone.